Should you put an adult child on your bank account? A lot of parents eventually ask a very practical question. Should I put one of my adult children on my bank account? Usually, the reason is simple. They want help. Maybe they want a son or daughter to pay bills if they get sick. Maybe they want someone nearby who can deposit checks, deal with the bank, or make sure the electric bill and insurance premiums get paid. That makes sense. But adding an adult child to your bank account may do more than give that child permission to help. Depending on the paperwork, it may give that child access to the money during your lifetime. It may also affect who receives that account after your death. That is where many families get into trouble. Today, I want to walk through the issue in plain English. What can go wrong, why your will may not fix it, and what options may be safer. First, let's separate two very different ideas. One idea is giving someone authority to help you. The other idea is giving someone ownership rights. Those are not the same thing. As you get older, if you want a trusted child to help pay bills, you probably just want assistance. You may not intend to give that child part of the account. You may not intend to change your estate plan. You may not intend to leave that child more than the others. You may simply be saying, I trust this child to help me if I need help. But the bank paperwork may say something more than that. For example, if you add a child as a joint owner, the bank may treat that child as having access to the account. Depending on the account terms, that child may be able to withdraw money. Even if the child is trustworthy, that can still create problems. What if that child has creditor problems? What if that child is going through a divorce? What if that child has financial trouble? What if another family member later questions how money was spent? Many family disputes do not begin because someone was trying to do something wrong. They begin because the paperwork was unclear or did not match what the parent actually intended. Now let's talk about what happens at death. Many people assume their will controls everything. They say, my will leaves everything equally to my children, so I'm fine. But your will may not control every asset. Some assets pass outside the will. These may include life insurance, retirement accounts, bank accounts with payable on death beneficiaries, and joint accounts with survivorship language. That means your will might say one thing, while the bank account form says something else. Here's a common example. A widowed mother has 3 children. One daughter lives close by and helps with errands, doctor's appointments, and bills. The mother adds the daughter to her checking account so she can help. The mother's will says everything should be divided equally among all 3 children. Years later, the mother dies. If the bank account has survivorship language, the daughter may receive the entire account. The other children may still receive equal shares of the probate estate, but that bank account may pass directly to the daughter. Was that what the mother wanted? Maybe, but maybe not. Maybe the mother only added that daughter because she was nearby. Maybe she still wanted all 3 children to share equally. If so, the account paperwork may have created a result the mother never intended. And once the parent is gone, the family may be left trying to figure out what was really meant. That can lead to hurt feelings, accusations, and sometimes legal disputes. In Texas, there are several types of account arrangements that can matter. The exact wording on the bank form is important. A joint account may allow more than one person to access the account. A joint account with right of survivorship may allow the surviving account holder to receive the funds after one account holder dies if the legal requirements are met. A payable on death account, often called a POD account, usually lets the account pass to a named beneficiary after death without making that beneficiary an owner during your lifetime. A convenient signer arrangement may allow someone to help with transactions without giving that person ownership of the account or survivorship rights. Those are very different results. The problem is that many people do not ask which one they are creating. They go to the bank, sign the form, and assume everyone understands the purpose. But estate planning should not depend on assumptions. Before you add a child to a bank account, ask yourself this question. Am I giving this person authority to help me, or am I changing who owns or receives this money? That one question can prevent a lot of confusion. If the goal is to help during your lifetime, a durable financial power of attorney may be a better fit. With a durable power of attorney, you can name someone you trust to act as your agent. That person can help with financial matters if you need assistance, but the money remains yours. The child is not automatically made a co-owner of the account just because they have the authority to help. That is a major difference. Now, powers of attorney still need to be prepared carefully. Banks sometimes review them closely. Older documents can sometimes create delays, so this is not something to scribble out casually. But in many cases, a durable power of attorney is cleaner than adding a child directly to an account. If the goal is to transfer the account at death, then a payable on death designation may be useful, but even that needs to be coordinated with the rest of the estate plan. For example, if you name one child as pod beneficiary on a large account and your will leaves everything else equally among three children, you may have created an unequal result. That may be fine if that is what you intend, but it should be intentional. The larger point is this: your estate plan is not just your will. It is your will, your powers of attorney, your bank account forms, your beneficiary designations, your deeds, your retirement accounts, your life insurance, and any trust documents you may have. All of those pieces need to work together. If they do not, your family may face the exact confusion you were trying to avoid. So, before you add an adult child to your bank account, slow down and ask a few questions. Do I want this child to own part of the account now? Do I want this child to receive the account when I die? Do I want all of my children to share equally? Could this child's financial problems affect the account? Would a power of attorney or convenience signer arrangement accomplish my real goal? And most importantly, does this account paperwork match the rest of my estate plan? Adding a child to a bank account can seem like a small step. In some families, it may work fine, but in other families, it can accidentally change the inheritance plan, expose money to external risks, or spark a fight among children after the parent is gone. The paperwork matters. If you are not sure whether your bank accounts match your will, trust, powers of attorney, and beneficiary designations, it may be time to review your plan. This is especially true if you have added a child to an account, named one child as a beneficiary, changed banks, remarried, lost a spouse, or have not reviewed your estate plan in several years. A good estate plan should not leave your family guessing. It should make your intentions clear while you are still here to explain them. If you want to read more about this, I've written a related article called "Should You Put an Adult Child on Your Bank Account?" You can find it on my website at harvillecox.com.